Hello students, happy learning. Today we are going to see banking theory, law and practice. In this we are going to see the introduction part of banking. Banking is needed for money circulation. Money is nothing but finance. Finance is the lifeblood of all economic activities such as trade, commerce, agriculture and industry. A bank is generally understood as an institution which provide a fundamental financial services such as accepting deposits and lending loans. Banking sector acts as a backbone of a modern business world. The banking system significantly contributes for the development of any country. Due to the importance in the financial stability of a country, banks are highly regulated in the most of the countries. Historical development of bank. The Riksbank of Sweden is the first private sector bank established in the year 1656. This is the oldest central bank in the world. It acquired the sole right of note issue in the year 1897. But the fundamental art of banking has been developed by the Bank of England in their 1864 as the first bank of note issues. A large number of central banks were established between 1921 and 1954 in compliance with the resolution passed by the International Finance Conferences held at Brazil in 1920. After that, most of the country were established their own central banks. In South Africa, South African Reserve Bank was established in the year 1921. The Central Bank of China was established in the year 1928. The Reserve Bank of New Zealand was established in the year 1934. The Reserve Bank of India was established in the year 1935. The Central Bank of Ceylon was established in the year 1950. And the Bank of Israel was established in the year 1954. Bank, the origin, the word is derived from the German word bank, which means a joint stock firm. Bank or banco was used by Italians to denote the accumulation of securities or money with a joint stock firm, which later on with the passage of time comes to known as bank. What is bank? A bank is a financial institution that accepts deposits from the public and creates a demand deposits while simultaneously making a loans. Lending activities can be performed either directly or indirectly through the capital market. Capital market is a market where you can lend or borrow long-term loans. Definition of bank. According to Banking Regulation Act 1949, banking means the accepting for the purpose of lending, or investment of deposit of money from the public, repayable on demand or otherwise, and withdrawable by the checks or draft, pay order or otherwise. From the above definition, it is clear that bank, after accepting the deposit from the public, lends or invests in various assets which brings revenue to the bank. Out of such earning, the bank will not only repay the deposits as and when demanded by the public, but also pay interest on deposits. Why the bank is very important? Because it safeguards our cash and it manages our finance record keeping of our daily incoming and outputs of our cash flows and used for budgeting. It receives our paycheck quickly using the direct deposit facility and facilitate our financial transactions for paying our dues and receiving our money. It ensures our liquid assets. Cash is a liquid assets. And also it is used as a debit and a credit card services. We can use debit or credit card services of banks. And we can earn interest by investing our surplus ideal money with the bank. We can earn interest. And also we can borrow any type of loan from the bank. It may be a cash credit or it may be a overdraft or it may be a clear loan or it may be medium as a long-term loan. And the bank is used for invest our money in the form of fixed deposits or recurring deposits. History of our Indian bank. The first Bank of India was established in the year 1770 under British rule, named as a Bank of Hindustan. The banking system in India was controlled and dominated by Presidency Bank in India before independence. There were three presidency banks were functioned in India. The one is Bank of Bengal, was established in the year 1809. Bank of Bombay was established in the year 1814. Bank of Madras was established in the year 1843. They were called as a presidential bank. And all these banks, all these three banks are merged in the year 1921 and named as the Imperial Bank of India. And in the year 1955, the Imperial Bank of India was renamed as State Bank of India. This is the historical development. Bank of Hindustan was the first bank in India, was established in the year 1770 and was closed in 1932. General Bank of India was established in 1786 and was also liquidated in 1791. Bank of Calcutta was the first joint stock bank established in the year 1806. It was renamed as the Bank of Bengal in the year 1809. Bank of Bombay was established in the year 1814 and the Bank of Madras were established in the year 1843. And these three banks are called Presidential Bank: Bengal, Bombay and Madras only. This is the structure of Indian banking, component of Indian banking. For in India, the Reserve Bank of India is the apex bank. It means it's the head of all the banks. And the banking activity in India, banks are classified into scheduled bank and unscheduled bank. For the scheduled bank is classified into commercial bank and cooperative banks. Cooperative banks are classified into urban cooperative banks and state cooperative banks based on the area of operation. And here the commercial banks are classified into public sector banks, private sector banks, and further this private sector bank is classified into old generation private sector banks and a new generation private sector banks, and foreign bank and a regional rural bank. So foreign bank, it means the bank were established outside India and permitted to operate in India are called foreign banks. Regional rural banks are the banks are operating in the rural area for the development of a rural area. Private sector, the whole that is more than 50% of shareholdings are held by the private person. Public sector banks are classified into SBI and associate banks, nationalized banks and public sector banks. Thank you for watching the video.